Could fines for vacant spaces be the game changer in revitalizing urban areas? Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. In Portland, Maine, city officials are considering a new ordinance that would impose fines on commercial property owners who leave storefronts vacant for extended periods. This measure aims to tackle the persistent problem of empty spaces in the city's arts district, particularly along Congress Street, which has been a concern for local businesses and residents alike. The proposal, if enacted, would require property owners to register their vacant properties with the city within 30 days of becoming empty. The city would then assist in finding tenants, connecting landlords with small business owners, artists, and community groups. However, if properties remain vacant, fines would be levied annually, starting at $250 for properties vacant for at least 3 months, escalating to $7,500 for those vacant for 10 years or more. City Councilor Kate Sykes supports the ordinance, believing it incentivizes landlords to actively seek renters. Meanwhile, Mayor Mark Dion expresses concerns about the punitive nature of the fines, emphasizing the need for supportive measures to help landlords fill these spaces. This approach in Portland brings to light broader discussions on how cities can effectively manage commercial vacancies. In Ontario, cities like Kitchener, Waterloo, and Cambridge could draw insights from Portland's strategy as they face their own challenges with vacant commercial properties. These areas might consider similar incentives or penalties to encourage active leasing and revitalization of their downtown cores. Across the border in the United States, urban centers are also grappling with similar issues. Cities are exploring creative solutions to fill empty spaces, recognizing the impact of vacancies on community vibrancy and economic health. After a challenging 2023 to 2024 period marked by aggressive monetary tightening and stalled deal pipelines, signs are emerging that the tide is shifting favorably for real estate investors, particularly in resilient sectors like industrial real estate. Interest rates, which had reached multi-decade highs, are now widely expected to decrease through 2025 as inflation stabilizes and the Federal Reserve moves towards easing monetary policy. The fundraising environment for real estate has faced significant stress. In 2024, only $131 billion in private capital was raised globally for real estate investments, marking the lowest annual total since 2012, according to PEI Group. However, 2025 is telling a different story. Momentum is gradually returning, driven by large sector-specific mandates and a strategic reallocation of capital away from challenged assets towards structural growth opportunities. One of the most notable signals came from global alternative asset manager Carlyle, which recently closed its 10th United States real estate fund. Carlyle raised more than $8 billion, surpassing the level raised for its predecessor in 2021, despite what it described as one of the most difficult fundraising environments for real estate in recent memory. Carlyle's strategy focuses on residential, self-storage, and industrial sectors, avoiding exposure to offices, hotels, and traditional retail, where structural demand remains robust. Industrial real estate stands out in this environment. Vacancy rates for small to mid-bay assets remain under 5% in most United States metros. Leasing activity has rebounded sharply in the second quarter of 2025, according to CBRE, driven largely by third-party logistics companies, nearshoring demand, and inventory realignment across Tier 1 and Tier 2 cities. Capital markets are taking notice, with transactions in industrial real estate gaining momentum after a slow 2024. Stabilized capitalization rates are holding between 5.5 to 6.5%, and investor interest is increasingly gravitating towards sub-$50 million assets. These segments offer value creation through lease resets, functional improvements, or infill redevelopment. The anticipated decline in interest rates could be the final catalyst that reignites the sector. As borrowing costs fall, internal rates of return on industrial deals become increasingly compelling, especially in deals where current cash flow already covers debt service and allows for fixed-rate refinancing within 2 to 3 years. The positive leverage environment seen in the mid-2010s might be re-emerging, particularly in markets like Atlanta, Dallas, and Chicago, where industrial demand is outpacing new deliveries. After 2 years of capital rationing, a new cycle of real estate investing is quietly taking shape, with industrial clearly among the favored sectors. With fundraising rebounding and capital markets warming to the first signs of monetary easing, the second half of 2025 into 2026 may present a unique entry point for investors seeking durable income and inflation-resistant growth. Institutional players are already repositioning their capital accordingly. Individual investors and family offices looking to capitalize on the next wave of wealth creation should take note. Australia's retail property sector has reached its lowest point, according to the Queensland Investment Corporation, and investors are now returning as the fundamentals improve. The Sovereign Wealth Fund sees this as an opportune moment for acquisitions, suggesting that the sector's downturn has finally hit its bottom. This marks a significant shift in the market dynamics, which had been under pressure for some time. The Queensland Investment Corporation's analysis indicates that the retail property sector in Australia is poised for recovery, with investor interest beginning to pick up. This development is expected to lead to increased activity and potentially favorable outcomes for those investing at this stage. The timing appears ideal for those looking to capitalize on the anticipated upswing in the retail property market. The 111-acre Malvern Office Park has caught the attention of real estate investors and developers, as it is now being marketed as a prime redevelopment opportunity. Located in a strategic area with potential for significant growth, this property presents a unique chance to transform an established office park into a vibrant, mixed-use community. The office park, which has been a fixture in the Malvern area, is now being positioned for a new phase of development that could include a mix of residential, retail, and commercial spaces. This shift aligns with broader trends in the commercial real estate sector, where there is a growing emphasis on creating multi-use environments that cater to a variety of needs and enhance community engagement. Market analysts suggest that the redevelopment of the Malvern Office Park could serve as a model for similar projects across North America. By integrating residential units with commercial and retail spaces, developers can create a sustainable community that leverages the existing infrastructure while meeting modern demands. The Malvern Office Park's strategic location, coupled with its substantial acreage, offers developers the flexibility to innovate and incorporate elements that appeal to both local residents and businesses. This development could potentially boost the local economy by attracting new businesses and residents, thereby increasing the area's vibrancy and economic resilience. The opportunity to redevelop such a vast tract of land is rare, making the Malvern Office Park a highly attractive prospect for investors looking to capitalize on the evolving landscape of commercial real estate. As urban centers continue to evolve, projects like this highlight the importance of adaptability and forward thinking in real estate development. In a significant move that underscores the growing trend of international collaboration in real estate development, Dubai Investments has entered into a strategic agreement with Angola's Sovereign Wealth Fund. This partnership aims to jointly develop large-scale real estate projects in the Luanda province of Angola, focusing initially on the Kazanga Island within the Luanda archipelago. This reflects a shared vision to promote modern urbanization and sustainable development across Angola's capital. Khalid bin Kalban, Vice Chairman and Chief Executive Officer of Dubai Investments, signed the agreement alongside Armando Manuel, Chairman of the Board of Angola's Sovereign Wealth Fund. This collaboration will see Dubai Investments leverage its extensive experience in real estate to transform identified lands into sustainable communities, unlocking urban and tourism potential in the region. The Angolan Sovereign Wealth Fund will participate through a special purpose vehicle that will hold the land rights for the designated areas. This structure allows for a strategic approach to development, facilitating the creation of new urban, residential, and tourism-led projects, which are expected to enhance the natural resources, coastline, and cultural heritage of Luanda. This partnership not only highlights Dubai Investments' expanding global presence, but also aligns with the United Arab Emirates' broader vision of fostering cross-border partnerships that drive sustainable growth and urban innovation. The first phase of this collaboration is set to focus on Kazanga Island, presenting a significant opportunity for both urban and tourism development. According to Armando Manuel, this agreement strengthens the Sovereign Wealth Fund's commitment to mobilizing international capital and expertise for high-impact real estate and tourism projects. Meanwhile, Angola's Secretary of State for Urban Planning, Manuel Kangazeze, emphasized the potential for this agreement to add architectural and scenic value to Luanda, improving the quality of real estate investments in the city. This development is a key example of how international cooperation can play a vital role in urban development, offering a blueprint for other regions looking to attract investment and foster sustainable growth. As we observe these global partnerships unfold, they provide valuable insights into the evolving landscape of commercial real estate and the potential for cross-border collaborations to drive innovation and economic development. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.